boy with the accounting accidentally site. This video is called 20,000 Tons of Pears and Cash Flow Management. Harry and David, this is probably a brand that you've heard of. Many of us have received gifts from Harry and David. It's a very popular brand, and I'm recording this on Cyber Monday when they get tremendous amount of orders during the holiday season. So this was spurred by an article from the Wall Street Journal, how Harry and David gets 20,000 tons of pears to doorsteps for the holidays. So the quality of pears and the care with which they are packaged are a big part as to why this gift company entices shoppers to spend $40 or more, a pretty big number, on baskets of fruit, chocolate, and other treats to friends and family. You've probably gotten these through friends. Businesses send these a lot. You've probably heard of it. Up to 800,000 pears are washed a day when they hit their peak period during the holidays. The fruit goes through a sorter, which reads out any blemished fruit or unwanted objects and sticks. A few dozen workers are trained to pick the pears that qualify for the gold foil in the gift boxes. If you've gotten the gift boxes, each one of those pears is wrapped in gold foil. It's pretty impressive. So 45% of the pears go in the gift baskets. The other ones go into products that Harry and David makes. So here's the challenge. This is a seasonal business. Harry and David delivers more than 1.5 million gifts during the holiday season between October and December, 3 months that account for more than half their sales. So this brings up the question, how do you manage cash flow for a seasonal business? And this is an example that I've used for years that I'm going to pull up on the screen. This is a cash flow roll forward. So I'm making up a company calling it Acme Rental. We have July, August, and September. A really useful tool if you're going to analyze cash. I'm going to blow this up just a little bit. So you have a beginning, and this rolls forward from 1 month to the next. So we have a beginning cash balance, 20,000. We pay out $100,000 for inventory purchases. And then we have sales on account. That is sales that are not paid right away in cash. So 300,000. And the way it works is, in my assumption, 80% of the sales are paid in the month following the sale, the other 20% in the second month following the sale. So what I have in red is July sales and when they get paid, here and here. And then we have blue August sales that get paid here and then further out in October. So I'm making the point that you're not getting paid cash immediately. You're getting paid cash over a period of time into the future. And you'll also see down here that we have cost of goods sold, which is, I'm making up for my assumption is 65% of sales. So July sales, 65% is 195,000. August sales, 65%, 234,000. Those numbers are subtracted. We're paying it out. And what we end up with is the ending cash budget. So July, 340, ending July becomes our August new balance. And in fact, you can see how they're linked. The August ending balance becomes the September starting balance. So why did I bring all this up? Because if you're Harry and David, during those really busy months when you're selling a lot, in the next month or two, you're collecting a lot. And the question is, what happens when you get further out, January, February, March, when sales go way down? How do you maintain enough cash to manage your business during the slower periods? And the best way to do that is to do this sort of cash flow analysis. And the answer is that Harry and David is going to have to conserve a lot of cash once they get through December so that they can cash flow their business and pay payroll and other expenses during the slow months. And they're also going to need to make huge inventory purchases of pears. They grow their own pears, but other items to meet the demand in the fourth quarter. So you may see in the third quarter that Harry and David is spending huge amounts on direct materials, direct labor to get ramped up for the holidays. You have to have the cash available in the third quarter to finance the sales in the fourth quarter. So the takeaway here is if you have a seasonal business, you need to work out your cash flow so that when you collect all that cash during the busy periods, you maintain and keep enough cash to not only pay payroll and other expenses through the slow times, but also so you can buy inventory, raw materials, pay for labor to staff up and get ready for your busy seasonal selling time.